And in three, two, one. Hello, welcome to another episode of the Real Investment Property Income Podcast. My name is Jeff Eady. Joining me today, as always, is one of Canada's top mortgage brokers, my good friend, the skipper to my Gilligan, Mr. Jonathan Tilger. Skipper, how are you today?
A little throwback to Gilligan's Island. I like it. I'm doing phenomenal. How about yourself, Jeff?
I'm great, thanks. It was either that or Ginger and Marianne, and neither one of us looked good in a dress.
Yeah, I agree.
Jonathan, I am pretty happy we did skip a week. We took a week off last week. Nobody yelled at us, so that's good. That's kind of one of those great things about working for yourself, I guess. But this week we are happy to be bringing a great guest from the Washington, Seattle area. I'm not sure if he's exactly in Seattle, but we'll find that out. So he is a real estate developer and managing partner of Aurora's investment group. Obsessed with growth, he flipped himself out of a corporate job in the healthcare industry and is now focused on helping others make their money work extremely hard through townhome construction and adding value to operational apartments. Please welcome Mr. Karl Krauskopf. Karl, how are you today, sir?
Oh, I am doing well. And today I identify as Ginger.
Well, I guess if you're sort of the Northwest coast, having that ginger skin, it sort of is made for that type of skin. So perfect.
Absolutely. Yeah, we haven't seen the sun in about 3 years.
and I like the way you play on words there with your intro. If you flipped yourself out of, that was very well played there.
Oh, absolutely.
So, Karl, I'm really happy. And sorry, did I pronounce the last name correctly? Krauskopf?
Yeah,
okay,
absolutely.
Good. Want to make sure that the sweetest sounding word in the English language is a person's own name. So I'm sorry. I try and do this professionally, but I have a 22-year-old cat in the background that I have to spray once in a while because she gets really loud. I'm all set up for it. And I was like, you know what? There's nothing I can do about her. She's old and I love her, and God bless her. Anyhow, back to what we're talking about. Karl, why don't you explain to us a little bit about what Aurora Investments does? I know I had a chance to look through your website and see what you guys are working on, but why don't you tell the folks out there what it is you do?
Absolutely. So we've got a couple different, really two primary focuses is ground up construction and then really focusing on the value add apartments. So underperforming assets either here locally, or we've got a couple markets down in the Southeast and an apartment down in Tucson. So really it's finding the underutilized, either whether it's land or operating assets, and getting them into a position where they're performing at the top end of the market. So right now, again, focused on the ground up construction side, we're doing a lot of townhome developments in downtown Seattle. Mm-hmm. And there are some regulations around backyard cottages where here in Seattle, we can actually sell off the backyard cottage completely separate from the primary home, using and converting the property into a condominium. So the nice thing about these is, we're still doing a little bit of flipping, right? We're flipping the primary home. And really what we're getting is the backyard, the lot, for free. And so our total cost basis is typically going to just be the cost of construction with a little bit of finance costs for the backyard cottage. Right now we're looking at, anywhere from around $300,000 on the hard costs for the detached ADU. And we're usually selling those between $600,000 to $700,000. So decent spread on those. And those are usually in and out in a under 9-month time frame. The townhome construction side, usually about a 12-month time frame.
I love that story. I mean, the fact that and these are the things I love, is people who have really taken the time to understand their market and find these little niches that they can use. So how did you find that the ability to do that? Is this common knowledge, or is this something you really had to dig to actually discover?
I wouldn't say it's common knowledge by any means necessary. Right. I just did a talk at one of our lenders, kind of meet and greet sessions earlier last week. And the vast majority of about, let's call it 15 out of the 20 people, had no idea that you could actually separate the detached ADU from the primary home. And there's even regulations here, again, in Seattle, where you can build an attached ADU. So you can really effectively turn a single family home into 3 separate sellable lots or homes. So again, really it's a unique play, especially for lots where again, that are being completely underutilized, where you've got a decent sized backyard, you've got a clear ingress and egress to allow construction of those additional units. And ultimately, we're serving the market, the homeowners, because these units, even though it's 600 to 700,000 for 1,000 square feet home, are significantly cheaper than the alternatives, right? Of 800, closer to $1 million for just a single family home.
Yeah, and my understanding is that's kind of the that is your guiding principle, is providing more affordable houses.
Yeah, absolutely. Whether it's home ownership or rentals.
That's awesome. And how long have you been doing this?
It seems like it's been forever. It's been the journey started about 4 years ago. 6 months into that, 6 months of that was just true education, self-education, reading, listening to podcasts, going to meetups, learning anything and everything that I could get my hands onto. Spent about 2.5 years after that, flipping, owning some rentals on the side. And about a year ago, a little over a year ago, 13 months, is when I made the exit from my corporate job. And the catalyst to that was starting a couple, 2 development projects.
Can I just ask what industry you're coming from that led?
Sure. Yeah. Healthcare business services. So it's an incredibly robust, yet also very confusing industry that I served. It was providing risk-based contracting for providers. So like hospitals, physician offices, stuff like that. So instead of being tied, their revenue being tied to services, it was being tied to the health of the patients, health of the members that they were responsible for. So it was a tough sell because we were selling very, very far on the horizon, and regulations, and we were susceptible to regulations of federal government. So it was a difficult product and difficult business model to sell.
Yeah, and it sounds very what's the word I'm looking for? Normally I'd call it ESG, but like in line with hey, you have to perform based on this. Like it's good for the patient, it's not so good for the healthcare provider, because a lot of them just don't really care.
Yeah, the very first stage or evolution of it was called pay for performance. So
okay, that's what I was looking. Yeah,
everybody would get paid. I mean, it was heavily incentivized on maintaining the health of the population.
That's kind of nice to see. That's something we don't really deal with up here. We have socialized healthcare, which is one of the great things about us. I know it's not so acceptable down where you guys are, but we are kind of moving a little more into a 2-tier system. Like there is better healthcare here, but at least everybody gets the same.
Sure.
That's my understanding. I'm not exactly sure how that works, but that being said, so you've had a pretty quick venture to now. Are you guys set up as a fund?
Not yet. So we will certainly be looking at creating a fund, most likely early next year, maybe late this year if things go according to plan. Right now, we are still syndicating equity for the project specific, each of our specific projects, right? So for each of the townhomes, for our apartment acquisitions, each is an individual project and raise.
Okay.
How did you go about that process of getting really, especially the hardest ones are always your first investors?
Yeah.
That's, I mean, number of people we've spoken with, but just the journey that brought you to find the first investors.
Sure. Surprisingly, the first investors found me. So it was completely unknown or accidental on my part, right? It was a lot of posting what I'm doing, social media. This is the flips. This is what we're doing from an apartment standpoint, buying multifamily. And friends and family reaching out of like, hey, I'd love to get into this. How did you start? Kind of walking them through the journey. Most of them, and so was I at the time, a W-2 employee. Most of them were just shocked. How are you able to manage both of these? And it was, well, I wake up early and I go to bed relatively late. So most of them were like, that's for the birds. I'm not trying to get on that boat, which is fine. A lot of times, the best thing for high paying individuals, high paying employees is really just to focus on performing within their function, within their job, and investing any of the additional or disposable income into real estate or other alternative investment opportunities. So they ended up reaching out to me wanting to invest. So it started off with 1 or 2 flips, having investors invest and fund the flips, and then it quickly became now I had about a dozen that were asking for investment opportunities, and kind of the next evolution of that was larger apartments, I'd call them mid-sized apartments, and townhome construction.
Gee, that's a good problem to have, more people asking to invest with you. That's terrible. What kind of returns do your investors normally see?
So we've got anywhere from 20 to about 35%, and that's within a 15-month basis.
What's your time frame of your typical investments? I mean, it sounds like you've got a few different categories of things you're doing.
Sure, good point. So thanks for that. On the ground up construction flip side of things, that's the 20 to 35%. So those are liquidated completely within a 15-month time frame. So right now we've done a lot of build to sell models, which have been great. But with the recent cost of construction rise, now we're looking at moving the next ground up construction into build to rents. So build to rent townhomes, build to rent single families, and those are probably going to be the 3 to 5 year timeframes, 3 to 5 year holds. The apartments, those are generally speaking ranging from 17 to 19% IRR, and cash on cash usually floats between 7 to 8%.
So I'm just taking notes as you say all of this. Like, Jonathan is more of a computer brain than I am. You sound like the way that Jonathan thinks about things, a lot more analytical. I'm more of a fly by the seat of my pants.
Sure.
I'm the sales guy. Do you deal with a lot of the sales, or I saw you have a partner? Yep. Like, how do you guys split responsibility for what you do?
Good question. And obviously partnerships can be really difficult, especially figuring out which lane to stay in and finding complementary strengths and weaknesses. Mm-hmm. Now, I was tremendously lucky, blessed, whatever you want to call it, to find and work and begin the relationship with my partner, Chris Bowen, who is the yin to my yang, and absolutely, the strengths that I have, the weaknesses that I have are, absolutely complementary on his side. So, really, I'm hyper focused on growth, business development, investor relations, whereas he's really, really incredibly detail oriented. He came from marketing agency. He came from project management. So he really focuses on running the operational side of things, making sure everything's smooth. We've got systems, we've got repeatable processes, whether it's from the beginning, my stuff, to the end of the dispositions.
That's actually something really interesting. Can you talk a little more about processes? This is something that Jonathan and I strive to put in place, and we have a number of them with our business, but it's something we're always trying to look forward to. Like, there's right now where if we fly by the seat of our pants, it's okay. But if we're going to do this a few more times, we got to have a process to it just to make it easy. It's got to be like McDonald's. The fryers are always on the left, right?
Yeah, absolutely. So, I'm the same way. Wild West cowboy. Most of my flips felt the exact same, but I didn't know necessarily how I was able to continue to be successful, other than it was all in my brain, right? Nothing was necessarily on paper. There wasn't any kind of job aids or really documented, repeatable processes. So that way, what we want to be doing and what we are doing is growing our employee base. And so, one of the biggest projects that we have together, and where we started, by the way, we've been together for about a year, my partner and I, is really documenting everything from the broker reach outs, the broker conversations, what are we talking about, how are we talking about it, all the way through underwriting, deal analysis, qualifying deals, and moving them through the negotiation, closing process, post-closing. I should mention, obviously, due diligence is being, one of the biggest processes that we really fleshed out, because, truly, you make money when you buy, right? And so the due diligence really ensures that we are buying the right asset, we're buying it at the right price. So we've got the pre-contract due diligence, and then we've got the post-contract due diligence. Typically things when and where sellers release additional information post going under contract.
So sorry, go ahead, Jonathan. Go ahead.
Just going to say, just from a rough kind of ballpark number of the number of deals you look at, how many do you actually take? I mean, this is always one of the toughest things with investing. As you say, you make money when you buy.
Yep. Yeah, that's a great question. So looking at the last probably 6 months, we are anywhere from 1 in 50 being actually going through the underwriting process. So I never underwrite anything. I do not underwrite something that has not made it past our rule of thumb, which we've kind of developed. Obviously, taking other people's rules of thumb and putting them into a repeatable, Excel spreadsheet, for instance. And really beyond that, it's an additional, I would say, probably 25 to 50 additional properties. So out of, let's call it 75 is where we're getting closed. So closing on every 75 that we look at.
So that's like 1 out of every 75 that you look at that you would actually, okay,
Yeah.
This is one we can work with now.
Yeah.
Just because the other ones didn't meet criteria.
Yeah. I should phrase it as 1 in 75 close. So, if you were to peel it back, right, if we're looking at 75 deals, 50 make it to underwriting, some number, I don't have the metrics in front of me, 20 probably get offers on them, 10 or maybe sub 10 get actually, the prices actually starting to match, terms are starting to match. And then we move down and actually close on one of those 10.
Okay, I got a bunch of questions. First of all, you're talking about what it is you're looking for in your general rules of thumb. I saw the areas that you guys are looking for. I'm kind of more interested in hey, this is the box that it has to fit in for us to even look at it.
What's the question there?
What is that box?
Oh, the buy criteria?
Yeah.
Gotcha. All right. So geographically, obviously we have, all the markets that we're looking at, obviously here locally, and then, primarily right now, the Southeast. So think of Atlanta and then several markets in Florida and some in North Carolina. So that's the geographical constraints. Then beyond that are, we're really, again, looking at the townhome, the ground up construction, and then the apartment value adds. On the ground up construction, we're only looking at that right now locally. Why? Because we want to make sure that we have a rock solid relationship with our developer, our general contractor, prior to putting something under contract. So the way that we look at it is obviously then we've got an apartment, and I'll talk about that in a second. Get into a remote market via a multifamily, some kind of mid-sized apartment, build relationships there, get our boots on the ground, and then begin understanding the development process. Because every municipality, every state is going to be different on the development cycle. Some are going to be easier to work with. Some are going to be a lot more difficult. Utilities are going to be a lot difficult. And then obviously, working with land. Land is going to be completely different from Phoenix, where the ground is incredibly hard, to Seattle, where the ground is soft. So putting in basements in Phoenix does not necessarily make sense as much as it does in Seattle. So developments right now, we're just looking locally. On the apartment value adds, right? What we're really looking at, when we started, was just on a pure cap rate basis. We said we don't want to look at anything that doesn't have 5.5% or more on a cap rate based on actuals. Well, come to find out, those are fewer and far between, especially when we're working with brokers. So what we decided to actually look at is the top and the bottom line, right? So splitting out revenue, splitting out expenses. From an expense standpoint, we're looking at underutilized, or rather underperforming, whether it's mom and pop managed, looking at the vacancy, looking at the bad debt and concessions, all the way down to the advertising, how much are they spending there? Really, it's looking at, is there a 10% operational efficiency that we can add within a 6 to 12 month time frame? So that's on the expense side. On the income or revenue side, really the ideal situation is where rents have not been increased since pre-pandemic. That's a little bit difficult to define, especially on the upfront process. But what we're looking at is, looking at the lease terms and the rent rolls. When did the majority of the rents start, right? If they were starting in like 2015 to 2019, likely is that rents are probably a little sluggish. And then if something started in the 2021, 2022 timeframe from a rent standpoint, then we're not really looking at it. Last on the revenue side is less than 25% of the units have been renovated.
Mm-hmm.
So
kind of within that spectrum, I've seen a lot of like motel conversions happening lately. Are you guys doing any of that stuff?
No, not yet. And that's a good question. I would consider that, obviously that's not ground up construction by any means necessary, but it's a major renovation, right? Mm-hmm. You're adding a deal of plumbing, typically a good deal of plumbing, especially if you're wanting multifamily units that are not just a bunch of studios. Mm-hmm. So, right now we have, yes, I've seen a lot of success stories with the motel conversions, but we haven't taken it on yet.
And then Southeast, I've seen, well, I don't know how much of it's marketing and propaganda, but with the exodus of a lot of the tech companies in a tax unfriendly environment of California, that Miami especially is trying to attract and become the new hub of technology. Are you seeing that? Like you were talking about Florida. Are you guys, is that why you're down there, or was it before?
So a couple of reasons. Florida, I grew up in Florida. I grew up in East Coast of Florida on the beaches, so I'm hyper familiar. I've got a lot of relationships already there. So from a boots on the ground standpoint, it'd be a lot quicker and easier to do. So that's kind of the primary reason. The secondary reason, yes, Miami has been trying to attract it, but really a lot of folks have been stopped, moving east, right? So Phoenix has absorbed a lot of that population. So has Austin, and kind of the next area is Florida, and then Atlanta, Georgia. Both Phoenix and Austin, in my personal opinion, are hyper overvalued. I just saw a report this morning that Phoenix was the highest inflation city in the nation. When obviously when we go through all the due diligence, the underwriting on Phoenix, most of the times the valuations come in close to 2x, two times higher than what we would be willing to pay for them. And that's typically because institutional money's coming in and they're betting on the market, not necessarily. They're betting primarily on the market, and then they're betting on the asset itself.
Mm-hmm. Yeah, it's funny. I Jonathan and I have both been down there a number of times, never together though. That's weird, Jonathan. I have a very special place in my heart for Scottsdale. And I remember looking at it was a 1-bedroom condo there with in a community where they had pools and everything like that. And it was big. Like it was probably 700-800 square feet for a 1-bedroom. Like it was big, built-in laundry. It was like $115,000 as recent as about 2014. Sure. And then all of a sudden the prices jumped within about, I'd say, an 8-9 month window. It was double that.
Yep.
It was kind of crazy to watch. And now the prices have just skyrocketed.
Yeah, that's exactly, initially we were looking at Phoenix, and again, we spent about probably 3 months in the market trying to find an asset that would work. But, really we were just getting priced out above, what we would want to be able to come to our investor group and offer.
Yeah, well, I break it down, and correct me if I'm wrong with this, or how I categorize it anyway, is the difference between investing in real estate versus speculating in real estate.
Yeah.
And I put it as investing, you're looking at, hey, what's the cash flow? How does this thing carry itself? Whereas speculating, as you say, you're looking more at what's the trend in the entire market, and is that going to move up to the point where it makes what you're doing profitable?
Right. Yeah, no, you're absolutely right. And I would categorize it the exact same way. Now there's benefit to blending some speculation into the investing, as you mentioned. And I think there's perfect opportunity and great room for doing that. But when investors are starting to really just favor or overweigh the speculation to the investing equation, that's when we back out. That's when we put our hands up and we back out.
Well, yeah, the like Jonathan just said, the revenue base isn't there for it to be supported by the speculative
Absolutely.
price. It
Yeah,
gets a little scary.
absolutely.
Sorry, Jonathan, you were going to say something there?
Basically along the lines of what you just said, it's like when you start saying, well, rents have to keep going up at sort of your 2% or so a year for the next 15 years for this to make sense. You're like kind of like, okay, there's a bit of a disconnect between
Right.
between the rental market and the purchase market.
Sure.
Eh.
And I think, we could absolutely spend a lot of time in the weeds on the underwriting side. 2%. I think generally speaking, lenders would look at anywhere from 3 to 5% being a safe year over year increase. Now, in order for me to make sense of some of those assets, I had to apply about an 8 to 10% year over year increase on the rents. And that was just considerably uncomfortable. So not going to happen. Not for us.
Yeah, that's kind of crazy. The other thing I wanted to ask you about when you're looking at all of these is how much has the cost of construction changed your business over the last, say, year and a half? It's
Sure.
really been. I know Jonathan and I were looking at working on a project very recently, and it would have been 9 units when it was done, and the numbers were really good until we got the quote from the contractor, and he's like, we had over $100,000 just in 3-wire that would have been needed for the project, and
Sure.
that's just the wiring.
Yep.
That doesn't include everything else. So you having the two different sides, you've got the value add where it's 25% or less has been renovated, and then you've got the ground up. I would imagine they're impacted pretty significantly differently by those costs to build.
Yeah, absolutely. So again, I'll start with the Phoenix example, and then I'll jump back over to local where we've done quite a bit of development. On the Phoenix side of things, well, let me even back up from there. In order for us to do a development, a ground up construction, we have to have 2 very favorable exit strategies, right? To the point where it's like, I want to go this route, but I also really want to go this route from an exit strategy perspective. And that would be the build to sell, the build to rent. So on the build to sell, we absolutely have to make a decent enough margin for it to make sense, both for us as well as the investors. And on the build to rent side, obviously we need to be able to hit certain cash metrics. We need to be able to we need to be able to refinance out of high interest construction loans. And then we need to be able to hit cash on cash equity multiple metrics by the end of year 5. Now, so that's kind of setting the stage. Looking at the 2 different markets, on the south side, on the southwest side in Phoenix, we were having a very difficult time penciling the build to sell because the cost of construction was very close, not completely disregarding the cost of the land and the cost of money. The cost of construction was close to the cost of resale on a per square foot basis. So on a lot of townhomes that we were looking at, you'd get $350 per square foot for resale, obviously excluding any of your commissions and selling costs, taxes, etc. On the build side, we were at about $200 to $225 per square foot to build. Now that only leaves us about safely, I would say $125 per square foot of a margin. Then you start factoring in cost of land, cost of financing, cost of selling, and our margins were tight, if not, break even in most instances. And so then we would, okay, how does this actually work? Typically, again, going back to we would need to be able to hold it for a 5 to 10 year basis in order for it to pencil. So on the southwest side, cost of construction was too close to the cost of resale. Didn't make sense for us. We'd have to hold it for longer than what we would want. On the Seattle side, cost of construction versus the cost of sale is a much larger margin. So we're able to more easily pencil the build to sell, and the build to rent is obviously a fantastic opportunity. So that's the other primary reason why we're so focused here in Seattle is usually those margins are going to be anywhere from $250 to $300 per square foot difference between the cost of construction versus the cost of reselling.
Is it because you guys are closer to the forest industry that costs are lower there?
I wouldn't assume so, because again, our cost of construction up here is going to be about 300 a square foot, all in, and down south it's 200 to 225. So they're getting our labor up here is incredibly expensive. Labor being one of the big things that factor the cost of construction here. Cost of materials is relatively still not, I wouldn't imagine that much different. Cost of just material on the material side.
Okay, so it's a labor. Okay, yeah. I mean, for us, the labor really hasn't increased that much over the last couple of years where we are, but the materials have pretty much tripled, almost quadrupled, depending on what you're talking about.
Yeah.
It's kind of crazy, and it's funny because there are opportunities. The challenge being that if with the property we were looking at, we got it for 50,000 less than asking, and people are like, "What? You made an offer lower than asking?" And somebody accepted it. Yeah, and when we said we couldn't take it, they came back and said, "Well, make us another offer." Sure. Like, you pretty much have to give it to us for us to be able to make money on it, and that's why they're selling it. Now, somebody with a big enough pocketbook and the right timeline could make it happen for sure. So there are opportunities out there. How do you guys source your opportunities?
On the ground up construction, it's a lot of it's obviously still broker driven, and a lot of it outside of just pure brokers are actual relationships, connections with other developers that have gone through the process, and whether again it's direct to developer or if it's through a broker. Typically what we found is developers are wanting to sell because of typically three reasons. A, access to current access to capital. Do they have enough money to fund it? Do they have enough? Do they have other projects going on? Two, a repositioning of capital, and I'll say reposition of capital and reduction of risk. So repositioning, maybe they've got a bigger apartment, maybe they've got a larger assemblage that they're working on, and they just want to reposition the capital and sell out. And obviously from that aspect, they are reducing or eliminating their risk from a market standpoint. And then lastly, it's what I found is some of the instances that we've talked with developers is they'll sell it and they want to retain, and again, this kind of goes back to the risk mitigation. They want to be retained as the general contractor on file, which typically is fine with us, so long as we know and we've seen enough of the developer work to really offset our own risk of taking them on.
Can you tell me about your first development?
Sure.
Yeah.
It's fun.
I want to know, like, there's always, obviously there's the, hey, we built stuff and put it together, but the emotional process for you, because just, being an employee to being an investor, it's a huge leap. And then to be building something it's completely different. It's not just, not just flipping a home. That's a lot.
Yeah. Yeah, absolutely. There's a lot more moving pieces, especially when you're talking about townhomes, right? If you're developing a single family or a detached ADU, it's pretty clean cut and easy, right? It's effectively the clean version of flipping a home, of doing it. And I should have mentioned most of our flips on the kind of towards the latter end of last year and the year before were all high-end luxury studs out remodel type flips. So we effectively did every single thing from the rough ends all the way through finishes, minus the foundation and the initial framing. So really what we did on the first development was learn a lot from the utility connections. That's being one of the biggest lessons learned through the foundation, and the framing work really was the only additional work that we hadn't done before. On the utility side, that was the biggest lesson learned of how to actually work with the municipality, the city, city-owned utilities, and operate according to a permit set. And on our first development, we ended up having a plan to go overhead on the electrical because the transformer was literally 10 feet away from our overhead strike, maybe 15. Let's call it 15 feet. And towards the end of the project, come to find out, they wanted, I would say about the middle of the project, they wanted us to actually go underground. So that was a huge lesson, right? We had to upgrade transformers. We had to bring the electrical underground. We had to add a vault, an underground electrical vault, map it out all underground. Again, just something that I did not expect through the development process is that things can change, right? Things can change on the construction side, right? And that's easy to field. Things changing on the city side or the municipality side, that's difficult and and typically expensive.
Yeah. How did you go directly to the municipality, or did you go through like a third party who kind of guided you through the process?
The former.
Okay.
Yeah.
We
were
submitting
application. Yeah, we were submitting application to get electrified, and they kind of pumped the brakes and sent it to engineering, which took longer than expected and longer than normal. And they came back with a radically different plan.
Can I just ask, at that point you did your first one, were you working with your partner at that point, or was that on your own?
I was on my own.
That was on your own.
Yeah.
What was the process, and how was it finding, because you've got these problems coming up? What type of support system do you have around you? Do you have people who are encouraging you? Did you have a mentor helping you, or was it just kind of you're flying by the seat of your pants saying, okay, let's make this work?
Yeah. So I certainly have mentors, and it's everybody around me that is truly the biggest reason for my success, right? I've got a mentor on the syndication and fund side of things. I've got a mentor on the home flipping financing side of things. And then I've got a mentor on the construction side. So it was really leaning on that construction manager, developer, builder, and really just pegging them for help. And, a lot of these people are very, very generous with their time, right? These are not, I would say, non-paid mentorships that, I can call them up at any time, and I know that they would have a hyper valuable response and a way to help me work through a solution.
I think that's a really valid point that can't be overstated. Everyone we talk to in the real estate industry, no matter what level they're at, always said that there was somebody willing to help them. There was always somebody willing to teach them. The Hollywood version of what a real estate mogul is versus the reality of it, I think, are two completely different things.
Right.
How did you go about building those relationships in the beginning?
It's a good question. Man, the first one, the finance and flip kind of construction individual. Yeah. I brought him value through actually just flipping a property for him. Right. He ended up teaching me a lot. We were part of a JV. I was kind of the general contractor, and he helped me through a lot of the processes. And obviously ended up making a lot of money for the partnership. He was awarded, or he owned the majority of the equity because he owned the majority of the risk. And so, it was really bringing value to him through that, really being the boots on the ground, managing the project for us. And, just continued to expand that relationship. I am a broker in Washington, licensed broker. And so any of the clients that I typically would get, I always refer back over to him, as he's also a mortgage broker. So again, just figuring out how I can provide value, monetary value to him without necessarily, directly compensating or directly paying him for any kind of mentorship work. On the syndication, the fund side of things, that was by happenstance. It developed organically from actually just hiking together, going on trail runs, helping with family stuff, that kind of, and it was just, again, an organic relationship that really was not rooted in me being able to provide him any benefit or any value from a business standpoint. Because obviously he's probably a couple light years ahead of me from a syndication side of things and running a business side. And then on the construction side, again, somewhat of a happenstance, he happened to be a subcontractor for me at every single one of my flips for the last 3 years. And he ventured into development. He's, I think was an insulation company owner for about 20 years. ventured off into doing developments. And once I got onto this townhome construction, I was able to peg him a lot for help, guidance, and answering questions.
I think even though you're maybe not providing monetary value, the companionship, it sounds like you're building a relationship with somebody as a friend, and this happens to be mutual beneficial. I think that's huge. I remember John Maxwell talking about how people would try and add value to him if they wanted to be closer to him. And one guy's like, he said one of his closest confidants started out picking up his laundry because he knew he just didn't have the time to do the laundry. Right. So he'd go grab it for him. And I think that's, especially starting out, being willing to do stuff like that without having to be rewarded for it. Or Jim Rohn, my favorite thing is asking poor people should ask rich people out to lunch.
Yep.
It's
and paying for it, by the way.
That's the key right there. Pay for it. And I mean, I've spent $150 on a lunch where I got millions of dollars worth of advice out of it. And it's kind of unreal what you can pick up from somebody who's just got years of knowledge. Sometimes, I wish I'd had tape recorders in my pocket. I guess I'm showing my age. There is no such thing as a tape recorder anymore. Wish my cell phone had a record feature on it.
Did you have to use your Super 8 for that as well?
No, it was a
microfilm.
DAT tape, I think it was, is what it was called. Yeah, DAT recorder.
It wasn't reel to reel.
No, Jonathan, you're older than I am. Shut up.
Goes back even more years.
Wow, that's you know what? I think on that note, I think we've covered a lot here. Is there anything you want to say to kind of finish this out, Karl?
I think just keeping in mind as an investor, whether you're new, seasoned, or whatever, wherever you are on the spectrum, is just get an idea. I think the biggest thing to me is understanding your risk tolerance, and ensuring that wherever you are in the spectrum of risk, that you have a level of due diligence ratcheted accordingly, or matched accordingly, I should say. So ground up construction all the way through kind of easy, simple real estate strategies, is make sure that you're doing the appropriate due diligence, whether it's you're the operator and you need to do due diligence on the purchase, or if you're a limited investor, limited partner, and you need to do due diligence on the operator that you're investing with. So just making sure that, again, as an investor, you're really focused on the due diligence side of things, and that you're vetting whatever opportunity you're getting into as much as possible, especially as we go into continued uncertain times from a financial investment standpoint.
Just as you were saying that, you made me think about the real estate investing world is kind of a two-tier thing. There's like the players down on the field, and then there's the fans in the seats betting on the players.
Yep.
Kind of interesting. Thank you for that. Never put that analogy together. That's kind of cool. Karl, who are you looking for? Who would you like for people to be looking to talk to you?
A couple different areas. Obviously, I'd love the business development side of things. So if you're a broker, if you're a developer, anywhere within the purchase and sale transaction, would love to have those conversations and just figure out, again, how I can bring you value from a solid offer perspective, or even as an industry partner, whether it's a developer, a builder, or any one of the other trades within the construction world, a lender, any one of those as well, all the way down to, I should say, all the way up to investors as well, any accredited investors that are interested in ground up construction, whether it's build to rent, build to sell. One strategy that I didn't mention on the build to rent side is building to rent with the intent to both do long-term leases as well as short-term leases. So think of Airbnb type models, especially on these new constructions, typically fare pretty well, especially in the townhomes where the walk scores or proximity to amenities are typically very high, very favorable, I should say. Produce a stellar Airbnb, stellar short-term, mid-term type product as well. So any accredited investors that are interested in either of those models, as well as obviously on the apartment side.
Fantastic. And how do they find you?
A couple different ways. I've got Instagram. So Aurora's Investment Group is our handle, as well as aurorasinvestmentgroup.com. And if you are looking to reach out to me directly, you can email me, Karl with a K, Karl, at aurorasinvestmentgroup.com.
And just to emphasize, it's Aurora's with an S.
Thank you.
Because there is another Aurora, so just not to confuse the two.
Is there?
Yes.
Well, Karl, thank you so much. We really enjoyed talking to you. I love finding out about different parts of the world too. Seattle is, I don't think we've ever had anybody on here from Seattle, so it's really cool learning about learning about the different how you can do the attached and detached ADUs. That's really an interesting niche in your market. So you guys are doing awesome there. I can't wait to have you back on, hopefully sometime in the near future, get some updates on what you're doing. I'd appreciate that. That'd be great. So thank you so much, Karl, for being here. And thank you for listening. If you want to know more about Karl, obviously you can go to aurorasinvestmentgroup.com. Is that correct?
That's correct.
Yeah, fantastic. Yes. I was paying attention. And if you want to know more about what Jonathan and I are doing, you can always go to guidetothegrind.com, download one of our books there. Karl, Jonathan, thank you so much for being here. Thank you for listening. Have a fantastic day, and we will see you soon.
Love it. Thank you, gentlemen.